a video about accounting.
Welcome to this presentation for Grade 12 Accounting. This is one part of a series called the 3 Fundamental Business Activities. Businesses cannot thrive or survive on their own. Here's my pen-making factory. In order to make money, my company must interact with the outside world in a variety of ways. It has to sell to clients and customers, hire and keep employees, work with suppliers and maintenance crews. It even needs to work with the government and others. Each of these interactions is called a transaction or activity. All of the activities that a business conducts are important to the survival of the company and must be recorded. Before we begin learning how to record these activities, we must first learn how to categorize them. In accounting, there are 3 types of business activities: financing activities, investing activities, and operating activities. For now, in this video, we're going to focus on financing activities. Financing activities are those activities that help a company get money to spend on improving itself. They're officially defined as activities that involve a company obtaining funds, cash in other words, that can be used to buy major assets to start or continue operating a business. Major assets are things that increase or improve the productivity of a company. The funds from financing activities can come from external or internal sources. Let's take a look at the 2 external sources first: creditors and investors. Creditors are individuals or companies that provide cash with the expectation that they will be repaid on a specific schedule or at a specific time. That can be short-term or long-term. For example, I could go to a bank for a loan for my pen company. If they agree to loan the company money, then the bank becomes a creditor until the loan has been repaid. Suppliers are a little trickier. If I order a bunch of ink that will be put into my pens, and the ink company says that I can pay them back within 30 days of delivery, then the ink company becomes a creditor until I pay them back. The philosophy here is that by not asking me to pay right away, the ink company is, in a way, lending me the cash value of the ink with the expectation that I will give them that value in cash within 30 days. The terms of repayment to a creditor are laid out in a legal document. Usually the repayment is the principal plus any interest that has accrued over the time period. You could use your simple interest equation to figure that amount out. Investors, our second source of funds, are again individuals or companies that provide funds, but the major difference is that instead of getting their money back plus interest, they get a share in the ownership of the company. Creditors are not interested in ownership of the company. For the most part, they are interested in making their own money by loaning money or selling supplies. Investors purchase ownership in a company, or they share ownership of a company, and so they're called shareholders. They purchase a share of the company in the form of stock, hoping to share in the profits of that company by earning dividends or selling some or all of those shares when their value increases. Here's a question for you that might help differentiate between creditors and investors. If my pen company goes bankrupt, to whom does the company have a legal obligation to try to repay? The answer is the company's creditors, because the nature of the business relationship is that my pen company owes them money. My company does not legally owe the shareholders money. In exchange for the money they gave me, I gave them a partial ownership in the company. But giving them money when I'm able to, in the form of dividends, is a good way to keep them happy and to encourage other people to purchase shares in my company. And when new people purchase shares, my company obtains more funds and the cycle starts again. The internal source of funds is called retained earnings. Retained earnings are the funds that come from net income after the company has paid out any dividends to its shareholders. At the end of a fiscal year, my pen company totals up its revenues, subtracts its expenses like wages, electricity, taxes, and then decides if it will share some of what is left over with the shareholders. If we do, we subtract that amount from the money we made that year. The money left over is retained earnings, so it's what it sounds like: the earnings that we have retained or kept. A company can use these retained earning funds to purchase new major assets. This is an important slide. It's a list of typical financing activities that you should know. The most important thing I want to communicate with this slide is that financing activities are not just the obtaining of funds, but also the reverse of that transaction. So, taking out a loan is a financing activity, but so is paying the loan back. Paying the interest, however, is not a financing activity, and we'll find out why in a different video. It is just paying back principal on a loan that counts as a financing activity. Selling shares to an investor is a financing activity. Buying those shares back is also a financing activity. Lastly, anything involving dividends is a financing activity. All of this is why I like the catchphrase loans, owns, and dividends to describe these types of activities. I hope this explanation of financing activities was clear. You can click on the link here to watch the other video, which will cover the other two types of business activities. Thanks again. See you next time.
Thank you for watching this video made by my dad.